Welcome to What's in Store with Carly and Chris, the show where we cover hot topics at the cross section of retail and real estate. I'm Carly Iacono, and I'm joined by my co-host, Chris Ressa. Chris, lovely to see you again. Good morning.
Good morning.
We have an interesting episode on some of the biggest retail deals going on right now. And we're going to touch on Walgreens, Nordstrom, and ROIC and talk about changes in ownership structures and what this means for both the companies themselves and investors. But before we dive in, I want to hear your biggest takeaways from ICSC OAC that we both attended last week. How was the show for you?
I don't think you were there on the Tuesday night. My father lives in Tampa and I brought him to the bar. So my dad met everybody in the industry.
What? I met your dad?
Oh,
Come
I'm
on.
sorry. That's right. You met my dad too. Everyone met my dad. That's right.
Everyone met your dad. That was like the
Yes.
highlight of the closing cocktail party at the hotel bar was, did you know Chris's dad is here? And there was a line to meet your dad.
I know.
It was the funniest thing ever.
Yes. And so that was cool. My dad got to meet a lot of industry colleagues and peers. So that was fun.
Yeah, that was a ride. And he lives right in Tampa, you said, right? So he
Clearwater. So Clearwater. So
okay.
35 minutes away from where we were.
And that was the big highlight of OAC for most people, meeting Chris Ressa's dad. Done. That's it. That's all we have for you.
Yeah.
Now, there was a lot of good takeaways. I thought some of the speakers were amazingly positive, right? Complete sunshine and rainbows. Everything's great. But I think overall that was the sentiment, was definitely to the positive on retail real estate. What was your takeaway?
Yeah, I think people, regardless of the volatility in the market, people are operating their businesses and have, there's a large group of people who feel a lot of this volatility is short term, and they are looking and planning for the future and operating their businesses for that. And I think that's really good. And people are super positive, right now on retail real estate. The fundamentals are still super strong, and people, in the consumer is still spending. Unemployment is super low. And generally speaking, for retail and retail real estate, regardless of some of the negative headlines, people are really positive who are on the ground, operating.
And the retailers themselves were extremely positive, with a hint of frustration that they're trying to grow. I mean, some of the projections they're putting out for 25, we won't go through all the retailers just to save time, but there's big numbers of projected or hopeful store expansion, but you could sense that undertone of, we need to find ways to grow. How are we going to do that? So I think that's consistent with what we've seen the last few years. Nice to see that drive and that push for expansion continuing.
Yeah. Yeah. And then there was a bunch of what I would call granular, super specific industry takeaways. Fixed cam is a hot topic. It seems like a lot of people in the industry are very bullish on fixed cam. This is the year of the assignment. There's a lot of assignments happening. If you're looking to grow and you have 30 locations and you're struggling to find, well, maybe the way is I buy a small chain of 3 stores. And I don't just mean assignments some one big, Kroger, Albertsons. That would lead to a lot of assignments in this huge merger. There's a lot of assignments that don't make headline news, where some 30 store chain, some 20 store chain buys a 3 store chain.
Right.
And there's a lot of things like that, because if you can make it happen, it's a path to growth.
So consolidation through assignment or mergers? Are you seeing it the other way, that assignment, that they're kind of spinning off certain groups of stores or business segments?
I don't even know if I would call it consolidation, because at the same time, there's other new business formation that's happening. I would just call it in the same way that if you're looking at, you mentioned the appetite to grow is voracious. And so the preferred method, because you control it, is organic store growth, right? My prototype my deal structure, all these things, the locations that I choose, and the leases that I made. However, if you're believing in your business, the path to, we're seeing all these innovative ways for people to get new locations. We're seeing the bankruptcy auctions super active. We're seeing people buying other businesses, and we're going to talk about some of the big ones today. So I think that, there's a lot of, we get assignment requests all the time where like local nail salon selling to another nail salon. And those are, that we have an uptick in assignments for sure.
Interesting. Just an active business climate, I think, is what that speaks to. People are moving, they're strategizing. It's certainly not the wait and stagnate that, some people are thinking it is when you read the headline news. So I think
Yeah,
that's the good news.
for sure.
So we could talk all day about takeaways from OAC because it was just a fantastic experience, wonderful conference. Really happy that we
But
could
there's
both
one other
attend.
takeaway we didn't talk about, which was
Okay. I was going to move on, but nope, go ahead.
artificial intelligence obviously was like a huge topic of discussion.
Oh, you are so right. That was one of my big takeaways. I have pages and pages of notes, been beta testing some apps and integrating AI into workflow. It's amazing who is using it, what companies are relying on it, and how. I was blown away by the AI sessions, actually. You?
So yeah, me too. So what I would say is there's the companies obviously are all taking steps. I'm sure CBRE is, DLC is, to try to get on the AI world. But I think there's a lot of things that individuals can do to get themselves accustomed and using AI. And there was a lot of takeaways to that, of like apps to try to play with it, to get used to like understanding AI and try to figure out how AI might help you personally, simultaneously as your company is working on big things that change the business landscape. So I think that was cool. Like the guy who showed us the robots. I
Yeah.
think that I didn't get his deck. I got to go to ICSC. Hopefully, I think you can download it. And he like had the report where he said he's going to show you like everything he showed, like the apps to use to try it and do that. And I haven't done that yet, but I plan on, messing around with that.
I was looking for all those files too, because there was a lot of exploration and follow-up that could come from that presentation. I think the breadth of things that are available, tools that are available to individuals, like you said, not at the enterprise level, which is a whole nother story, but just the individual level through Chat GPT or based on generative AI is amazing. Video, audio, coding, just everything you can think of. So I've been telling colleagues, family, and friends nonstop since I got back, just try it. Just start using it. Doesn't have to be every day, but just start learning, because if you don't get familiar with the capabilities and you don't start testing it, then I think you're behind. That
Yeah,
was the
for sure.
takeaway for me, was you've got to jump in, whether you like it or not, it's here and you got to deal with it and make it work to your advantage. So that's what we're trying to do over here.
Awesome.
So today's episode is kind of going in a different direction, but I think it's a timely one and something that is on a lot of investors' minds. And this is the privatization of retailers. So want to look at this from two sides. What going private means from a real estate investor perspective, triggered, of course, by the huge Walgreens Sycamore news, and then what it means from the retailer perspective. Why would retailers want to go private? Are there benefits? Are there rosy stories where this really was a wonderful angle? So we're going to touch on big picture, what it means from both sides, and then look a little more depth at Walgreens, Nordstrom, and ROIC, which are all three very different case studies that are relevant. So let's jump in to what does it mean? Just basically, why would a company go private? Why would this ever be a solution? I've got a lot of ideas, but why don't you kick us off?
Well, I think that, I think it starts with that, a company might not feel that the public markets are valuing the company on what they believe it's worth. And so it starts there, right? And then what that ends up doing at times is it forcing you to do things to try to improve that scenario. And when you might start, when you might have other strategic initiatives that you want to do for the business in the long term that don't necessarily match that. So I think there's that's one of the key reasons, I believe.
Flexibility is a
Yeah.
big one, right? When you're a public company, you're so constrained by the analysts, the shareholders, your growth directives. It's a pretty clear-cut path with a lot of requirements. So I think flexibility is a big one that can be a pro for the retailer, and like you said, probably drives a lot of the decisions that they want to maybe go in a different direction, or they feel that the street is not accurately valuing the business. I think the second piece is financially driven, which could be good or bad, right? When you're a public company, you have access to public money, which is the reason a lot of companies go public in the first place. But then when you take it back private, you can look at different lending solutions. You have more flexibility on your debt. You can do things like sale leaseback transactions to monetize your real estate that aren't really as
Well,
widely used when you're public.
you can make investments that don't have short-term ROI gains, but you believe are right for the business long term, that are tougher to do sometimes, because everyone always talks about Amazon, how because they're so big, they have the ability to take all these shots and try these new things.
Right.
Smaller entities sometimes don't have this luxury, being smaller and public, to do that because they're forced to produce returns consistently. And so I think that it might enable you to make investments that you might not be able to when you're public.
Although, think about Amazon. Think how many years they were not profitable, right? Everyone cites, okay, let's get away from the pressure of quarterly earnings calls as a public company, the pressure of reporting financials in such detail so frequently. How did Amazon get away with being not profitable and losing money for, I don't know, a decade, right? Just on the other side of the coin, and look where they are today, but they somehow avoided those earnings pressures and
I
kept
mean, I think
going.
in the
I
beginning
don't
they
know.
had those pressures. I think at the end of the day that you know the growth in market share, they got the market to believe in the vision of the amount of market share they were gobbling up, and there was a path to it, and they got the growth story is what got them there.
So you
Right
can
there.
overlook the financial pressures, right? If you have just an insane growth story that gets everyone comfortable with
I
the end
mean,
game,
I
which of course played out exactly as they
yeah,
predicted and more, but it was a
yeah,
long way though. It was a long
it
path.
was, it was a long path.
Yeah, interesting. Any other reasons that retailers might choose to go private? We touched on some financial, you know, flexibility, strategic flexibility. Maybe they want to take the business in a different direction. Anything else you can think of that would be driving that the opposite, right? Going from public to private.
The other reason might be on a restructuring, right? They might need to, the business might not be doing well, and someone feels they see a path to restructuring it, and so they end up going private in order to do that and restructure the business. And restructure doesn't just mean financial; it can mean anything. To restructure and reorient the business happens often, right? Someone's public. Um, it was going to be public because it was a growth story, and it's not growing in the manner, and so a restructuring um, could be needed, and the path to that could be from going private.
Let's look at it from the real estate investor perspective. This is especially relevant in my business line with the Walgreens Sycamore deal. We have so many clients, private clients, REITs, you name it, who own Walgreens, and everybody's affected a little differently by the news. One thing that we're watching is the change in ownership affecting loan covenants, right? So if they're not a public company or you don't have the same financial reporting, is that going to be a breach of loan documents for some of these investors? We don't know yet. Actually, we're following up with clients. We're following up with some of our private REITs to say, how are your lenders looking at this? And I don't think anyone has a clear direction yet, but it can have material change when a company goes private to existing investment properties. Have you dealt with anything like that at DLC? I know you're funded a little differently, but have you had any issues or any experience with loans being called or loan terms being changed when the status of a retailer changed?
So typically the lease allows assignments, and typically the lender approves the lease. So I think that's the nuance there in scenarios, right? Like those covenants you're talking about. I would say that in general, when the lender, uh, the person was buying it, the lender looked at the lease, they approved that lease, which allowed Walgreens to assign to sell their business. So I'm curious to see what happens. I don't know that that's going to be. I'm no expert in this. We'll see if that ends up being a concern. I'm not too sure if that is, because typically the lender approves the lease. The lease allows Walgreens, allows the tenant to sell their business. That's the story.
I know there's some provisions that are affected if a company goes from investment grade to non-investment grade. So I wonder if going from publicly traded investment grade, clear transparency on the financials to just private, right, with no financial reporting, theoretically, I could see a scenario where that would be a breach of loan covenant. Yes, the lease is approved, but now the financial status or what was required that they are an investment grade company for XYZ
Yeah,
type of
that's
loan,
different. No different than
that
like
could be it.
if you fail a DSCR test or something like that.
Right. Right.
Um,
But
Stuff
this
like
could be
that.
in mass very quickly, right? A lot of locations. So I don't know. We'll see. Lenders are going to have to figure it out. I don't think it's going to be a widespread, loan default, because lenders want to keep the loans in place. But I'm not sure how that's going to be dealt with. So things like that, not just in Walgreens, but in all investments, if a retailer goes from public to private, I think are something that investors need to start thinking about. They need to speak to their lenders. They need to review their leases and just understand how any changes with their tenant, whether it is an assignment, which yes is allowed in some cases, or whether it's a change in ownership structure of the company, affects their investment. I think that's an important piece.
Yeah, I think the generally what I see is the biggest concern of, the landlord community is, historically when private equity puts a lot of debt on a business to buy it, and then, retailers could get in trouble, and what is the long-term viability of that retailer when they go, and they have much more debt put on them, and that's like a lot of the fear, right? We saw this with Toys R Us and other businesses, them coming, and when I say Toys R Us, I just mean the fact of what happens when a retailer has, too much, is over levered. So I think that's like one of the fears. One of the things I would say though is, like, if you just look at Sycamore, like on some of the retailers they've owned, there, recently there hasn't been mass store closures. There's been, expansion. They bought, uh, Hot Topic and Torrid, and those retailers. So everyone fears, like, someone goes private, and like there's two paths, you could go. You could go to, like, I bought this and the sum of the parts is worth more than the whole, and they start making cuts. They close stores to pull in cash, and they run the business very differently. But oftentimes you see a scenario where they do think it's undervalued and there's a path to growth, and you just look at, like, Michael's went private, and they just have been on a store expansion tear. Barnes went private, been on a store expansion tear. And these were both bought by private. Apollo bought Michael's, and the group out of London out of the UK bought Barnes. And so, there's this fear that but one of the things typically is typically one of the easy, if they think there's a growth vehicle, one of the paths to monetization for the take private is to eventually go public again. And one of the ways you do that is you got to increase the market share, increase the EBITDA, and show a growth story. And so while there's some concerns sometimes when private equity buys a retailer, like Bain owned Burlington for a while and then took them public, and then look at the tear that Burlington's been on. And so I think, I don't know what the strategy is specific to Sycamore, but even you look at some of their other purchases, like, hold on one sec, let's look here.
I know they bought 9 West,
So Sycamore
Coldwater
bought
Creek, I think.
Staples,
Oh, Staples, that was a big one, yes.
right?
But they haven't been on an expansion tear.
But they haven't
I
been
would
on a
say,
closing tear, though.
well, because they had already closed most of their stores.
They haven't been on a closing tear either in the business, right? They haven't really been on this
I
like
don't think
mass
that's a
store
great
closure.
Story. I don't know. I wouldn't think of.
I'm not saying it's a great story, but I don't know that it's a great story, but my point on that is it's not as if like people like think, oh, someone's going to buy this and then all of a sudden they're going to close all these stores, all these poor performing stores. Like that's the narrative around Walgreens we're seeing. Like that.
That's the concern, right?
That's the concern.
That could happen,
right? That's the concern. I maybe I'm naive. I'm not so sure. Like you buy the business and then all of a sudden you take all this volume and sales out of the business by closing stores. That's not the MO usually.
And well, I think it depends on how much real estate they own and how they're looking at the real estate. Are they leveraging the real estate, closing stores and selling the real estate to pay down their basis in the deal overall? Or are they looking at real estate as a valuable asset, holding on to it, growing, or maybe doing a sale leaseback with a long-term lease and maintaining the business? So I really think it's how they perceive the importance of the real estate overall. And that's going to dictate their store closings versus sale leasebacks versus expansion, right? I think that's what we're solving for right now.
I would say, and maybe that's the case here, but like in general, in recent times, private equity isn't buying retailers for the real estate, generally speaking. Generally speaking, retailers are a consistent cash flowing business. People are coming into the store every day. And it is when there's a proven model, there's an easy path to speak to growth, Barnes, Michaels, what have you. Now, that doesn't mean there's not negatives from growing too fast, putting too much debt on the books, all those things. But I do think the concept of a mass store closure is not typical. That's the atypical in those transactions. Could it happen with Walgreens because they're in a different scenario? Sure. But I would that's not the norm.
And I think we all hope that's the case, right? Would prefer stability in the market and all these locations continue with a stronger business model. I think the other thing investors are looking at or thinking about whenever private equity gets involved is the use of real estate in a sale leaseback scenario. I go back to the Red Lobster case study, which, what was that, 2015, 16, when they were bought by Golden Gate Capital. They executed a widespread sale leaseback at very elevated rents in the market, sold off the real estate at a premium, and then didn't focus, in my opinion, as much on the business operations. So probably worked out great for them. I don't think it worked out great for the end investor who held the real estate. So I don't think private equity is necessarily always bad, but I think there are some points that you don't want to be involved, right? If you're an investor owning a location with very high rent that is a sale leaseback with a private equity company, I think there's risk there. Versus if you're a retailer who maybe was bought by private equity and now you have a new business plan and some, interesting flexibility to grow with some different capital, like maybe that's a very positive angle. So I don't think it's all rosy, but I don't think it's all negative either. And there's a lot of different ways it can go and a lot of different case studies.
Yeah, I think that so in general, if you signed a lease with someone or you bought a property with a tenant in there and tomorrow the tenant is different, there's always risk. It's not what you thought when you bought it per se.
Right.
So there's always risk with that, right? And that's the nature of, assignments, purchases and sales. There's always a risk with that because you went into it, we talk about this in, when we're signing deals with tenants to come into the centers, right? Like having, as much control over the assignment as possible because we're making a deal with this group and tomorrow it could be a different group. So there's always that risk. I just make the point that if you go to Google and you look at the main narrative I see is like, what does this mean for store closures? And
Right.
Walgreens was already talking about like smaller stores and this and that. And that could be the case. I just think that's not typically the MO. Even like Red Lobster, they might have done sale leaseback. There hasn't been mass closures of Red Lobsters. There's still a bunch of Red Lobsters out there.
There's still a bunch, but there were a lot that were closed. But yes, there's still
How
a good
many Red
number out there.
Lobsters closed?
I don't know. We'll have to put that in the show notes. I don't have
We'll
that
put that in
number.
the show notes. But in
Okay.
general, like I think that that's the concern, and I just think it's not the normal.
Right. So that's a fear. You're saying it's more of a fear headline everyone's latching on to, but that's not the MO of private equity. So this deal may not be as big and scary and negative as we think. So it sounds like you don't have the same loan concerns either. So maybe this is just a change in structure that does not have the immediate widespread effects that everyone's worried about, which would be great. I love your positive angle.
Well, we'll see. There's no doubt that there's been some, like I said, typically the real, in my opinion, where retailers get in trouble when they're bought out by private equity is when they get over levered is the major
The
thing,
debt load. Mhm.
right? That's
And
the
interest rates
major
are
thing.
still high, right? So debt's expensive. So that piles
those
on
are
quicker.
that's the typical, but yeah.
Well, I like that you gave us some bright spots on the Walgreens Sycamore merger. I think it's an important conversation for the industry because they have so many locations. So this is going to affect a lot of landlords, all the way from institutional to small private clients who maybe this is their only asset. So it's going to be an interesting thing to watch unfold. And I very much hope that they really strengthen the business, find a way for Walgreens to continue in an even better fashion. So we're gonna go with that and keep
We'll
our eye
see.
on it. Yeah, exactly. Let's move on to Nordstrom. Different scenario, different buyout discussion. So they went private in a deal where the family retained, I think it was like 51% control, right?
Yeah.
And sold 49% to another operator, another investment company. I think you're closer
Yeah.
to the Nordstrom deal.
Yeah.
Tell me how that worked and why you think that made sense.
I just think, Nordstrom's talking about like they believe in their business long term. They've been expanding rack. They've rationalized the department store. And I think, they were, I don't know that they believe they were getting the value from the public markets that they thought they were worth. And they tried to take private scenario in 2018 that didn't work. And so they sold to this, this investment company that owns a department store chain in Mexico. I don't know a lot about them, but different than like your typical private equity. And I think Nordstrom believes this is going to give them the flexibility to make the investments in the business for like really long-term growth and is better for the health of their long-term future of the business. And I think this was super interesting. And we'll see what shakes out. I mean, they're still out operating the business as normal. And, They've really grown rack, and they were, in that 2018 period, they were starting to be like a concern and like potentially on, watch lists for people. And now they've totally turned the ship, and now they're taking it private. And I think it's an interesting story. We will see what happens. But, they're really strong operators. They're really good at retail. And I think this could be potentially pretty good for them.
Sounds like a pride of ownership story too, right? That's family ownership. They didn't like the way the public markets were dictating what they had to do with the business. They didn't think that the pressure to grow in a certain way was what was best for the business. So they took their half, or just a little more than half,
Yeah,
private to retain control. I mean, that's an amazing sort of American business story, that we
totally.
believe in this. We're going to take the risk on because we believe in this so much. We know this business inside and out, and we can do it better without all the outside influences and pressures. So that's a big
Yeah.
statement from them, right?
Yeah.
Big sign of confidence, which I love. I think it could be
Yeah,
great.
The Nordstroms are still in the business. They're running the business, and
Love that.
yeah,
So this could be a positive example, right? That this is really the right move, that they didn't need the public markets and they think they can do it better switching gears here. So like we said, it's not always negative. In some cases, it's really the path forward for flexibility and, I would say, tailored growth, right?
I mean, if going back to the Sycamore Walgreens, if not a private equity scenario, what would what do you what should have happened? Because from a public market scenario, they were in the news all the time about like everyone was telling changes they should make and they should do, and all these like what do they do if not get bought private? What do they do? And I don't know that there was like, so you mentioned like this is the positive with the implication that the Sycamore could be more negative, but compared to what? Compared to staying public and probably forced to do some things that are just as, potentially negative or worse for, some of the real estate operators out there.
Yeah, I guess that's a way to look at it, right? They hadn't found a path for growth the way they were operating before. And obviously, Wall Street does
Yeah.
not like that. That doesn't bode well for the stock price and the financials. So I guess, they really did need to make change. So it certainly gives them more flexibility. I just worry, like we mentioned earlier, about the debt load, the lack of transparency in financials for investors, just sort of the lack of understanding of the direction of the business, because there was so much reporting before. I mean, we listened to every earnings call, really tried to dive into quarter to quarter financial performance and talked about that with our clients all the time. When they're private, you lose that. So maybe it's better for them. It just becomes kind of a mystery.
It comes down to relationships. It comes
Okay.
down to relationships. That's what I would say. Meaning, just because they're private doesn't mean you lose transparency to that information. Comes down to
Oh, you just have to,
relationships.
right, find it different ways. Okay.
Yeah.
Fair enough. Fair enough.
Yeah.
Let's talk about our third example, which again is completely different, and that's ROIC. So Blackstone is taking them private. I think that just happened, right? End of
It did. It
end
did.
of
So I
last
just
month,
think,
was it? It was
yeah.
very recent. Yeah.
So there's just any things around retail. There was, since December, there's been some major announcements that, on whether it's a landlord, whether it's a retailer, on just some, major public companies going private. So yeah, this is one like there's been definitely a significant amount of public REITs that have been either taken private or merged with other organizations, right? This has been going on since like right before COVID, right? We had
Hmm.
a lot of big ones, right? We had RPAI and Kite and Kimco and Weingarten and Kimco and RPT and Simon and Taubman and
Bear REIT was in there. Yeah.
Barry
Go on.
and Realty Income and all
Right.
these groups. And this is one that's one company's taking them private. And so I just think that, or they're buying them because Blackstone, the Blackstone is buying them. Blackstone is a public company, but they are taking them out of they are buying with ROIC.
Almost
So
like
I
a
think,
consolidation, right? They're still
yeah,
public, but now it's under Blackstone. It's just different
yes.
than the other
So
deals.
I think that, this speaks to a bunch of things. This speaks to, in my opinion, like one of the largest real estate owners in the world, really bullish on the retail space, right?
I know, I love that. Love that storyline. It's true.
Right.
Okay, go on.
Really, really bullish on the retail space. It speaks to, um, the fact that, on this consolidation of the REITs, the public retail REITs, and this continually shrinking down the number of public retail REITs. And it just speaks to, like, as you said, the business activity going on, right? Despite the volatility in the marketplace, people are still running their business and still looking for massive ways to grow, right? There's a ton of capital clearly flowing into things that are touching retail now, whether it's the billions of dollars on the Walgreens and the billions of dollars on the Nordstrom and the billions of dollars on ROIC. There's a lot of dry powder coming into the space and chasing massive swaths of retail. So I think those are the three things for me. One, it shows the strength of retail real estate. This company is going and attacking retail real estate. Number two, it definitely speaks to the continually shrinking the number of public retail REITs. And then number three, I think really speaks to the amount of just dollars chasing overall the retail landscape.
Yeah, I think that's certainly a positive story that one of the largest, if not the largest real estate owner in the world said, we really need to grow retail. How do we do that at scale?
Yeah.
And buying another public company and sort of folding them in makes all the sense in the world, especially when they own quality assets. So I think that's more of a growth story, not that ROIC needed the capital to change their business model. I think that was more Blackstone saying, we want a bigger presence in this segment. How do we do it? So still a positive, but the headlines, I think, trend like we started with, that anytime a company is taken private or taken off the stock market, that it's a negative. And obviously there's a lot of motivation, a lot of different angles, and a lot of outcomes depending on who's behind the capital and what the strategy is.
Yeah, for sure.
Don't always believe the headlines. Like we say every time, right? Just listen to Carly and Chris. Stop reading the headlines. We'll tell you what it really is, and you save yourself a lot of time.
There you go.
Chris, thank you so much. Great to see you as always. Really appreciate your comments on some of the biggest retail deals of the year. It was a lot of fun talking about Walgreens and ROIC and Nordstrom. Really appreciate all your commentary.
Thank
To
you.
everyone listening, thanks for joining us this month. We're so happy you tuned in, and we look forward to seeing you again next month. Take care, everyone.